Today is Nvidia earnings, is 11/20, and if you go to our implied earnings move chart, this is a free chart you could actually get. It's great for tracking earnings names. You can see a 7% implied move for Nvidia. That's the one-day move. And so this is usually what the focus is right into earnings. What is the one-day move? What is the one-day move? And we think that is taking your eye off the ball in this case, because we think that the market is broadly underpricing the amount of movement we're going to get after earnings. So let's talk about that a little bit. This is our founder's note. We write this every morning. And what we showed here for our subscribers was, look, here were the previous three reports. After February, we had a one-day move of 16%. June earnings, we had a 9% move. And then August, we had a 6% down move. And so we're pricing in 7% today. We think that we could easily break that move on a one-day basis. But again, the bigger theme here is what is going to happen after that earnings report, what happens in the days and weeks. What's interesting about this skew into recent earnings reports is you can see November here, it's the teal line. That's where we are today. Implied vol seems really subdued into this earnings report. Like there's not much of an expectation. And to that point, we have an IV rank of 38% for Nvidia right now. That's a 30-day option, so that's pretty low. The skew rank is 0.6, which is very neutral, right? That scale goes from 0 to 1. And so there's very low expectations, we think, on this earnings report, which tells us that if there's a beat or a miss, the reaction could actually be stronger than most people are pricing in. And let's just talk about those key levels out of the report. To the upside, 160 is the obvious upper bound for us on that initial move. And then 120 all the way down to 120 is kind of the lower bound of what we think we could see on a miss. So that's the one-day move. But again, that is the small potatoes thing here. I want to show you this chart here. Let's just look at it a little bit bigger. Let's bring up NVIDIA. And what you're going to notice out of here is the bigger term or the longer term picture here. So I highlighted the NVIDIA moves. You can see those here. And what you get is get rid of the S&P move here initially. You see 43% move in the weeks after the February report, 46% move in the weeks after the June report, 21% down in the weeks after the August report. And so this move seems to be setting up in a very similar way, only as per our IV rank in looking at skew here, the market is not pricing in this substantial of a sustained move, right? You look at implied vol at 58%, which is what one month at the money options are pricing. That's 3% daily moves. Well, I think we could easily get that. And then the other thing that you want to note on here is that the S&P, if I can line these up for us here, the S&P tends to have really large moves as well. So if you look at the trigger here out of earnings, you can see oftentimes 5+% moves higher and lower timing with these NVIDIA earnings. And it makes sense, right? NVIDIA is the largest stock in the S&P 500, but there are also over 500 different ETFs, many of them levered, that own NVIDIA. And so when NVIDIA starts to go up or down, it triggers movements in all of these NVIDIA ETFs. Not only that, there's all these options flows. NVIDIA is oftentimes the largest options complex, meaning it has the most volume, even bigger than the spiders or SPX. And so you get these dealer hedging flows that are something like a margin call, right? If dealers have to start buying stock, they're going to buy the stock. And then suddenly you have all of these ETFs and all these other knock-on flows that have to react in kind. And so that is what the trigger is for us, or our view, in this volatility. And so as a broad call here, it's like, look, the market's underpricing volatility, which means, of course, look, market can go up, stocks can go up or down, but it's going to go more, we think, than the market is pricing. The way that we're choosing to play this is via SMH. SMH is the semi-stock ETF, and we're buying SMH calls for January. And the reason that we're looking at January calls is because if you go and look at skew for SMH, what you'll see here with January, particularly like these 20 delta calls, right? They're statistically quite low, quite cheap on a 30-day basis, which means that if earnings are good, then we could really see these calls pay off, we think. This is not a recommendation. We don't know what NVIDIA earnings are going to do. This is simply saying, let's cover this right tail, right, in case the market starts to move a lot. The other thing is we have this meme mania, right? The meme mania right now is focused on names like Tesla and Reddit, and it's kind of the Trump names, right, that are so strong, crypto, right? And so if we get this marriage of the Trump memes with the AI memes, and that we think could really generate a lot of volatility. So we like that upside in SMH. Now, Obviously, we don't know which way earnings are going, and many of you may be picking up here at the top of our screen is the VIX, which is at 18. The other side of this equation is an Nvidia miss, and the puts, quite frankly, are underpriced as well. The other thing that the market is dealing with right now is the Russia-Ukraine escalation. That situation is really putting a bid to vol, and you could end up with a scenario where Nvidia kind of misses, and then there's a significant escalation. Um, and so we have been saying, look, our core portfolio, as long as we're above 5,900, we want to be long stocks. You can see we're under that in the S&P right now. We think it does make sense to add put protection. So you could buy puts and buy calls and still make money in this market if volatility expands like we think it will. And that downside is not really being priced. And so to the theme of people not appreciating how much volatility we could get to the downside, we think that the market is under hedged to the downside as well. And if we get a geopolitical event, even though the VIX is up at 18, and we think that the S&P is rather fluid all the way down to the 5,500 level. So for us, we are risk off if we go under 5850, excuse me, in the S&P. So we're going to wait and see. Look, if Nvidia earnings aren't good and we break down on that level, then we'll choose to start focusing on that downside, right? We'll flip from this trying to look for a position for a right tail or a strong move higher in markets, and then we will be forced to sort of capitulate and look for a longer term move if we break 5850 tomorrow after earnings. And in terms of prices heading out, just broad market prices, there are big positions at 5,500 in the S&P, and so that would be kind of our worst case downside move in December. That's what we'll be looking at. But for the upside, it gets a little interesting here because there's not a lot of positions to the upside, both in Nvidia over 160 as well as in the S&P to the upside. And so what you start to look at, instead of a price upside, we start to look at a time upside. And what that means is that December options expiration is one of the biggest expirations of the year, maybe one of the biggest expirations of all time. And so what you could end up with is a breakout here where there's just sort of reflexive positionings and a squeeze that sort of lasts and takes us up into that December options expiration. And so, from a broad-based perspective, again, we think volatility is really going to expand. You don't have to play this into earnings. You can wait to see which way the market's edging, we think, after earnings and play a large directional move. But that key insight being, again, that we think that broadly the market doesn't appreciate how much movement we could get out of this earnings report into the next couple of weeks. So if you have any questions on that, please let us know, info@spotgamma.com. You can leave some questions in the comment section as well. And if you want to track our daily notes, head over to spotgamma.com and try out a subscription. Thanks.